This is the second lecture for Monday, September 14th, and it will finish off chapter 4. So the last little section is actually financial statement analysis. All right, the first thing they talk about is comparative financial statements. Whenever a company issues a financial or annual report, they have to issue several years worth of financial statements. They typically will issue at least 2 years of the balance sheet and 3 years of the income statement, statement of retained earnings, statement of stockholders' equity, and the statement of cash flows. But there are other things that require disclosures for up to 5 to 10 years. All right, so when people are analyzing the financial statements, they might be analyzed by people within the company or outside the company. Generally, both of them actually are going to do common size analysis. They're going to look at rate of changes, which is 1 year to the next, and they're going to perform ratio analysis, right, to see how assets and liabilities compare to each other, for instance. All right. Time series analysis usually looks at changes over time. We're going to look at one that just covers from 1 year to the next. And then Intracompany, all right, so Intracompany looks at current year information and compares it to prior years to see what kind of trends are popping up or are occurring. All right, Intercompany compares the company's information to that of other companies. So you might want to benchmark or set goals based on what other companies are doing, or you might want to see how you're comparing to other companies within your industry, and that would be intercompany comparisons. All right, common size analysis. With common size, you convert everything to a percentage, and that allows you to compare corporations of different sizes because now you're looking at percentages as opposed to dollar figures. It's hard to compare dollar figures when one company is much larger than another company. And it also allows you to see, if you're doing some intracompany analysis, how things have changed from 1 year to the next with respect to your financial statements. Okay, so here we have 3 years worth of dollars on the balance sheet with respect to the current assets. And then what they do is they convert them to percentages. In this particular case, let me see, do they go down to total assets? Total assets is the 100% figure. So everything is divided by total assets. So for instance, this goodwill number, let's look at that. The percentage here for 2017 would be 1539.2 divided by 14,365.6, and that gives you 10.7%. Okay, so it's the individual number divided by total assets, and that's how they got all of these percentages. All right, so long-term investments for 2017, the 3.8% was 542.3 divided by 14,365.6, and that's how they got the 3.8%. On to liabilities. All right, if we skip down a page, we'll see what the total liabilities and equity is. Remember, total liabilities and equity and total assets equal each other. So basically, everything is divided by total assets or total liabilities and equity because it's the same number. All right, so over here where they have, let's look at retained earnings is 38.7% for 2017. This is the 5563.2 divided by the 14,365.6, and that's how they got 38.7. Okay, and notice that liabilities and equity is 100%. Okay. Then you can tell what makes up the bulk of your totals. So retained earnings is 38.7% of total liabilities and equity. Let's see what's next. Long-term debt is their next biggest number here. Back up here on the balance sheet, Let's see, property, plant, and equipment was a pretty good chunk of total assets, which makes sense. And then they also have a pretty good chunk in cash. You might want to do a little something with that cash other than have it sitting there. Okay. Rate of change of analysis is basically when you try to see if things are increasing or decreasing over time. All right, notice that you cannot do it if the base period is 0 or a negative number. You can't do the calculation. Okay, so here's Starbucks for 2015, 2016, and 2017. The rate of change in the total assets, this is for 2015 to 2016. So you do 2016 minus 2015, and then you divide by the earlier year. Okay? So it's current year. Put it in the text box. It's current year minus the previous year divided by the previous year. And that's how you do the rate of change. And you could do that to the balance sheet. Later on, we'll do it to the income statement or whatnot. Okay, so if we look at this right here for cash and equivalents for 2017, this number, this 15.7, is going to be, we're looking at for 2017, so it's going to be 2462.3 minus 2128.8 divided by the earlier year, so 2128.8. And that will give you actually 0.157 or some variation of decimal places, which rounds up to, or which converts to 15.7%. Okay, so that's how you do that. Now, I do want to point something out. This is how I'm accustomed to seeing the balance sheet in any of the financial statements. And by that, I mean, they're giving you the current year and then the previous years. Okay, so it's current year and then it goes back from there. Now, when you go to do the homework, and I did problem 15 and 16, your homework is problem 17 and 18. And they have it reversed. They have the previous year and then the current year. So it messed me up when I was talking about it and working it out. So keep that in mind when you're working it out. Okay, always be mindful of what order they're presenting the information. All right, and you can go through and see. So like long-term investments here, from 2016 to 2017, they went down by 52.5%, but they had bought quite a bit in 2016. From 15 to 16, they went up a lot. So they obviously sold something, okay, or moved it somewhere. Perhaps they moved some of it down here to equity and cost investments. So they changed up how they were classifying one of their long-term investments. And they did the same for the liabilities and the equity. All right, now we're down to ratio analysis. Ratio analysis is where you look at the information on the balance sheet and you try to figure out the position that the company is in. So it looks at the relationships between assets and liabilities and equity. Okay? The first one they talk about, let's see if it's in the book too, return on investments on page 436. And it's basically how well they're using their resources. Okay, so return on investment is your net income, but you add back net interest expense. Okay, this term right here is referred to as net interest expense. And we're adding back interest expense because interest expense is not a cost of our daily business. It relates to how we financed the assets, and we don't really want to take that into consideration. It says net interest expense. When I say net, it's net of taxes. Because we deducted interest expense and it saved us a little bit of tax money. So if I add it back, I wouldn't have saved as much tax. So that's what we're doing right here. And then it's divided by average total assets. Okay. Then return on common equity is net income divided by average total common shareholders' equity. It only applies to common. So if you happen to have preferred stock, you need to subtract that out of total equity to get the common equity. Now, these both are returns. So typically, oops, I didn't mean to do that. Typically, it would be stated in percent form. All right, so here's an example. This one was, here's our net income, here's the interest expense, the tax rate was 33.2%. The assets down here came off the balance sheet, all right? So they have net income plus net interest expense divided by the average assets. And then they multiplied it by 100, whatever their answer was, and they got 20.6%. In 2016, it was 21.5%. So they did a little bit better in 2016, tiny bit better. But return on equity wise, they did a little bit better in 2017 than 2016. All right, and this tells you what they did, what it basically means. For this 20.6%, basically means that for every dollar invested in assets, they generated 21 cents of profit. All right, then we have risk and financial flexibility ratios. All right, some of them look at financial leverage, which means that we're borrowing money to make money. Generally speaking, the higher our leverage or the higher our debt, the riskier it is for us to borrow money. So perhaps when we go to creditors to borrow money, they may not lend us money because we're already very highly leveraged, or perhaps they might offset that risk by charging us a higher interest rate. Just kind of depends. So there are a couple of different ratios that we're going to look at. One is debt to assets, and it's just what the term says. It's the total liabilities divided by total assets. All right, debt to assets. And this shows us how much of our assets are financed by debt. All right, debt to equity is basically a comparison between the total liabilities and total common shareholders' equity. Notice it's common shareholders again. And then we have some examples in here. All right, so Starbucks debt to asset ratio is 62, which basically means that 62% of their assets are financed through debt. All right, and then the debt to equity ratio is $1.63, which means that for every dollar that common shareholders have invested, Starbucks has $1.63 in debt. It's not necessarily bad. It just kind of depends on how leveraged they, what their interest rates are and if they're financially stable. All right, liquidity ratios usually deal with more short-term analysis. All right, because, liquidity means we have cash or we have assets that will convert to cash relatively quickly, or we want to figure out how fast they're going to convert. Okay, so some of the more common ones. Current ratio divides current assets by current liabilities. All right, very short term. We use our current assets to pay our current liabilities. So it really kind of shows us if I want to borrow money on a 60-day note, would I be able to pay it off? That person's going to look at my current ratio. The quick ratio is even a more stringent evaluation because it only looks at quick assets, which you think are going to be converted within 90 days. So generally speaking, that's usually cash and accounts receivable, short-term investments, and that's usually about it. Okay, then we look at operating capability ratios, I think I usually call them efficiency ratios, but it tries to calculate how fast inventory is turning over, and then receivables and payables, so that we can calculate the operating cycle, how many days in an operating cycle. So inventory turnover is your cost of goods sold off the income statement divided by the average inventory. So you have to do the beginning plus the end divided by 2. All right. Anytime that you see average in a equation, it's just beginning plus the ending divided by 2. And we're going to have it a couple times, not just with inventory, but with other items as well. And so that's how you get the average inventory. Perhaps I should highlight it. Oh. I'll just change the color of its text, because I have issues highlighting in here. Okay. Then if you want to know what that means in terms of days to sell something, you take 365 days and you divide it by the average, you divide it by the inventory turnover, okay? And that tells you how many days. So obviously, the shorter the number of days, the shorter or the smaller the inventory turnover, the fewer days it takes to sell. Okay, the smaller this number, then you're going to sell it faster. I'm sorry, the higher the inventory turnover. I'm going insane. Let me write it out. Higher turnover means less days on shelf. So you want a higher turnover, which is less days. I probably need to get done with this because it's late and I'm losing my mind. Let me make this a lot smaller. Actually, do this. Sorry, I'm taking up too much time doing this kind of stuff. Okay. The accounts receivable turnover ratio looks at how fast the accounts receivable are being collected. Okay, so once again, it's kind of the same thing. A higher turnover means less days to collect. Now, the accounts receivable turnover is your total credit sales. It's only sales on credit divided by your average accounts receivable. All right, it's the same thing. Beginning plus ending divided by 2 is your average. And then to find out how many days that is, it's the 365 days of the year divided by the turnover. And you would like it to be a lower number. The lower, the better. That means you're collecting your receivables faster. All right, the accounts payable looks at how long it takes you to pay your accounts payable. This one's a little bit different. It's inventory purchases divided by average accounts payable. Right? Average accounts payable is beginning plus ending divided by 2 for accounts payable. Inventory purchases is a calculation we don't normally see, and it's the cost of goods sold plus the change in inventory from the previous year to the current year. All right, and then once you get your turnover, you divide that into 365, and that tells you on average how many days it takes for you to pay your accounts payable. Then your operating cycle is those 3 numbers of days: the inventory turnover in days, accounts receivable turn in days, and then minus the accounts payable turnover in days, and that tells you roughly how long your operating cycle is. All right, and Then on here, they give you a little table with all the ratios, and this is on page 4-41. And it's for Starbucks. Another one that, fixed asset turnover and total asset turnover are basically the same, except that fixed asset turnover is just for fixed assets. Total asset turnover is for total assets. And it's your total revenues divided by your average total assets. And the average is the beginning plus the ending divided by 2, as always. Okay? And it basically shows how well you're using your assets to generate revenue. And that is it. I posted problems 15 and 16, which do this and which do these calculations. So go watch those videos to do your homework.